Welcome back to the Global Ledger. I am Justin. In the last several episodes, we've built a foundation from the ground up. How liquidity drives markets, how the global dollar system works, how dealers operate, what the Fed actually does, how banks create money, the hierarchy of money, and how repo powers the shadow banking system. And today we're going to bring all that together in one of the most important concepts in finance, and that is the discount rate. This is the bridge between the money side of the world, funding, liquidity, collateral, and the finance side of the world, which would be valuation, risk, and cash flows. So this is where balance sheets meet models and our liquidity meets price. So let's dive in. So what is a discount rate? In valuation, the discount rate is the number you use to convert future cash flows in today's value. If cash flows are the what, the discount rate is the how much does it cost to wait. But that's the finance definition. From a money perspective, the discount rate is simply the price of risk-bearing capacity. It's what it costs to get someone to hold a risky asset instead of a safe one. And that cost is determined not just by economics, but by funding conditions. That's the secret most finance textbooks skip. So let's build the chain clearly, starting from liquidity. So number one, liquidity conditions change. So repo, funding spreads, dollar availability, dealer capacity. Then funding costs move. The price of borrowing, the price of hedging and rolling positions. Number three would be dealers expand or contract their balance sheets. This is the willingness to intermediate risk. Then risk premiums adjusting. How much investors demand to hold certain assets. This is where discount rates move. Get the cost of capital, required returns. Then valuation changes. Asset prices either rise or fall. And that's the sequence I think is necessary to put out there. So this is why markets can move violently, even without any new economic information, because the discount rate changed. So the discount rate is a funding rate. Let me break this down. So here's the key insight. Discount rates are not set by the market. They are set by the conditions under which markets fund themselves. So, example, dealers fund themselves through repo, corporations through bonds and credit markets, banks through deposits and wholesale funding, and shadow banks through collateralized lending. When funding is cheap and abundant, balance sheets expand, risk premiums shrink, discount rates fall, and valuations rise. So when funding is tight, the opposite. So balance sheets contract, risk premiums will fall. Risk premiums will rise, and discount rates jump, and valuations fall. So this is why valuations are more of a monetary phenom, not just a financial one. Why interest rates alone, in my opinion, don't explain valuation. So everyone tries to reduce valuation to interest rates went up, stocks must go down. But it's a little more complex. The discount rate includes the risk-free rate, the credit spread, the equity risk premium, liquidity premiums, volatility premiums, funding spreads, collateral dynamics, list goes on, dealer balance sheet capacity. So this is important for us to constantly be reminded that markets are not about interest rates. They are about risk premiums. And risk premiums come from funding markets, not economics in the textbooks. So let's talk about the global dollar discount rate. We're going to take it global because global credit, global derivatives, trade, global investment are all financed in dollars. So the world effectively shares a global discount rate, and that global discount rate is shaped by Fed policy, dollar liquidity, swap lines, repo markets, cross-currency funding, offshore dollar creation. And this is why emerging market valuations collapse when the dollar strengthens. This is why global assets move together in crises. And this is why risk-taking worldwide depends on U.S. liquidity. The discount rate is no longer local. It's global. So where do dealers come into play here? Let's connect this back to dealers. Remind you that dealers, they warehouse risk. They hedge exposures. They fund positions in repo, quote prices, and stabilize markets. When their balance sheets tighten, volatility rises, spreads widen, liquidity thins, and discount rates jump. When they expand, volatility falls, spreads compress, liquidity improves, and discount rates drop. Dealers are the discount rate mechanism in modern markets. This is why having a view of money wrapped inside valuation, I think is important. So why the discount rate moves even when nothing happens. So I don't know if you guys have noticed, but great earnings, stock drops per se. So bad earnings, stock rallies. No news, huge moves in the markets. Good macro data, bonds crash. Bad macro data, yields fall. This isn't randomness. We've talked about this before. This is liquidity because hedging pressures shift, margin requirements reset, funding spreads widen or narrow. Collateral availability will change, and dealers adjust their risk appetite. If the discount rate moves quietly, prices move loudly. This would be a good way to explain it. So, and again, always tie this into the noise of and I would say I wouldn't say the noise, but I'd say why understanding the discount rate reduces uncertainty and why it matters in this series. Many investors do fear volatility. I fear volatility. And sometimes because maybe they think markets move for emotional or political reasons. But when you understand the mechanics of what's going on, liquidity, funding, collateral, balance sheets, risk bearing capacity, the markets they can start looking a little less chaotic. They can start looking mathematical. Structured and logical, I'd say. So, and again, I always say that's the purpose of this podcast is to bring clarity, bring a sense of certainty to our understanding of what we're talking about, and it's not so scary after all. So again, thanks for listening to episode 10 of the Global Ledger. We connected the world of money to the world of finance and valuation, and revealed the mechanism behind discount rates. In episode 11, we're going to explore a little bit deeper on this and the discount rate. And we're going to talk about risk premiums and how markets decide what risk is worth. So if you're enjoying the show, leave a review, share it with a friend, spread it somehow. It helps us be able to reach more people and bring clarity and to a somewhat foggy world. So once again, I'm Justin, and thanks for being with me.